coming back today with another video. Um, I don't know if anyone ever even see these videos. Hopefully, some people at least eventually learn the concepts. But if you've been watching some of the previous videos, either some of the things you'd be thinking is, okay, are you implying the only way to trade is through machine learning and through algorithmic trading in some way? Not algorithmic in that the market is, but algorithmic in you have certain metrics for risk and for liquidity for volume that you're able to utilize certain environments. Um, and that is an aspect of trading that's very profitable. And some people are gonna hear what I'm about to say and go, "Nope, it's you have to use machine learning in some way." And that to be profitable every single day, to be able to make multiple trades every single day, that might be the case. That might be the case. But there is some way you can still trade off of visualized price with these concepts that directional movement makes sense. You don't need to know all the metrics and all the math proofs to be able to trade in some way if you still understand and have like some indicators um, for volume and for liquidity or for risk. Sorry. And the reason is in a stable market, right? In a stable market, liquidity is used by these funds and by these asset management systems as a tool to manage their positions, to increase profitability, etc., etc. Right. However, as retail, the only things we really need to matter is what they have to do, and what they have to do is manage a certain amount of risk per day. They have to manage their exposure, right? And these funds operate through market inefficiencies, through single stock, through cross asset processing, where cross asset pricing, where one stock might be overvalued, one's undervalued, and a market is reflective of that is different. They have metrics that are able to look through various markets and find those inefficiencies, and they're able to look into deep pools of liquidity. But if a lot of that ends up looking in visualized price simply as more extreme volatility, or in the case of futures markets in ETFs, likely very little. And the reason for that is a lot of trading that is made by these funds is informational based trading, right? A skew in that information, right? When they have the upper hand in knowledge, they're able to be aggressive, which is what their actions tend to be. For portfolio funds, their information allows them to um, manage their risk. So, what we can think is, all right, when entering the market, we're not really looking at individual candles. Right? What we're looking at is how was price managed the previous week, previous month, previous days? Why is that the case? Right? Why has that been the case? Right? Maybe we do a little bit of cross-market analysis, see, how risk rotation is being a thing. If some risk is being rotated out of some long-term risk in positions is being rotated out of futures and ETFs into commodities or into metals or into energy, into defense. Those are all things we can look at and see the overall market sentiment that is going on, right? And then we can apply that to an expected amount of volume on the day, expected amount of volatility on the day, and then see, right, what is our catalyst, right? What is our moving factor, right? If it's nothing, right, if there's no information on the day, there's no economic report, there's no major policy decision, then our catalyst is the positions that need to be managed and certain pools of liquidity, right? And that is a standard concept, right? As well as coupled with the constant, what we discussed recently, how much can dealers lend out? How much volume can we expect, right? But as I was saying, kind of a minute ago, this is all based on visualized price. How are we going to be able to determine how much money dealers have, how much money is able to be injected into the market? So for that, we really can't. There are certain levels where different people can understand those things, compute those metrics. If you can very easily understand that from a bond yield point, consistent rates that change over months and quarters, then yeah, sure, utilize that in your thought process. I wouldn't weigh too heavily on that, but the reason why I say that is or why I say this is there is, all right, suggestive price action here that this like fair value gap, I guess, tiny, is being tested right now. Right? That's not true. What we have here is, this Asia slow chop, all right, this set of a high, all right, this is being rotated to the upside, all right. Then we have risk was managed aggressively to the upside, which is why we have this volume weighted average rise, all right, and then it dips to fill orders here, all right. This is our New York session where, and the lines haven't been set for the highs and lows, but this is our New York session where this is our move of the day, right? This fill from London into the opening of New York, right? The sweep, risk is managed to the upside, right? And then you see in the afternoon right now, what time is it? 2 at 2:30, an afternoon session where you have this rebalancing, efficiency balancing. Price is drawing back into this volume weighted average. What's not happening is like people are gonna see this price action wise, or they're gonna go back test and go, these concepts make sense. These concepts make sense because I'm clearly seeing, there's starting to be some form of resistance at this point. But there's not. What there is there's a slow of volume, all right, and a want, or sorry, an either want or unwant to avoid risk. Right? People do not want to be held into positions after close that are against the average, which is why price will return to it typically, after lunch. When you see a volume drop off and a volatility drop off, right? It doesn't have really anything to do with well there's a gap here. So it needs to go back to the gap. There's an element where there is enough management that the afternoon session calls for this much of a pullback back down to that weighted average. That is true. That's true. There is not. Well, there's this gap on the 15-minute time frame. So therefore, take price here. And how we trade that is saying, okay, you know, we're seeing some upwards pressure into Asia, all right, where we have very little volume, very little volatility. So a lot of this is trading, high frequency trading around this volume weighted average. And if there's not, if price strays away from this average, right, either we have some, risk management to this upside. There's some play to this upside that is worthwhile, either in creating for the next day or in rotating positions, right? We see that in these highs. Then, as London sets and New York is looking to open, we see this creation of price being drawn below the volume weighted average so that more buyers can enter. And then for New York, we see buyers enter, risk is rotated to the upside, where there is some, hopeful, you know, just hope. I don't even know what I was gonna say. Just hope for these positions to be good. I guess not hope. Metrics providing this to be the smart play on the day, or depending on the fund, what simply needed to happen was price went to the upside. All right, and then in the afternoon, when positions don't need to be managed, all right, when positions were managed with large volume early in the session between your 9:30 to 11, we have this return to the average where, as discussed in previous videos, 2 p.m. to 4 p.m. we usually have price around this volume weighted average, so we can have high frequency trading. Um, a lot of I'm pretty sure I don't want to go really too deep into this video because I feel like there's more concepts that aren't really probably needed right now. But that high frequency trading has some ability on liquidity supply um, during that time and allows for there to be better created farther down the intraday cycle. Um, but yeah, the reason I was making this video is to kind of show like there's not really a setup. There's not really a strategy. There are machine models and mechanics that you can implement, and there are proofs on high frequency trading, especially for uh, certain volume thresholds and certain risk thresholds, which are incredibly profitable and are equivocal to a model, equivocal to like I guess a strategy. However, you can trade without one. Very, very doable, and it is not incredibly technical. It is technical a little bit in like understanding, all right, well, this is the 50% of volume, and if there's not an extreme catalyst for price to move a certain degree, likely we're going to see that return to volume. But that's kind of all it is, and also understanding, how much risk needs to be managed and when. If we're in New York, we're going to see some pretty extreme volatility and large volume. If we're in London, we're probably not going to see as much. If we're Asia, we're probably going to see literally nothing, because the volume is so low. There could be, reasons why that's not true. Um, is there any crazy Asian move I can point out? I think so. Yeah, look at this crazy Asia spike. All right, what is this? 712, a 30-point move. All right. I don't remember what happened on January 26th. I would be very confident in saying there was a large price catalyst which caused for that. Right? There was either, a Trump policy decision or some policy decision in Japan or in China which made risk have to be rotated like that. Right? There was not like price at this level. And that's not to say that also isn't the case. Like um what we could be seeing the past few weeks with some decrease in overall stock price is like that could also be largely profit taking. Like there is a point where in these very long yearly positions, you have to roll that over, or you also have to like take that profit. And when markets have been at all time highs for I think like 6 7 months, 6 7, but 6 7 months, I'm pretty sure, maybe even a little more than that, a little less. At a certain point, hedge funds have to take profits. You know, these portfolio managers might be able to roll over their positions. They might be able to switch their longs to shorts, etc., etc. But these hedge funds, which are very aggressive and seek to make look profit, they have to take some of their money out at some point. And whales as well, people that actually just have huge majority positions in individual stocks and individual funds. When those people look to take profits in unison, you can't see some like some fear rotation where these portfolio managers have a bigger bulk of open positions. They also cycle them in some way to decrease their exposure. When stocks move 5% down on a day, even if that is just hedge funds and whales, and even like a good bit of retail taking out profits from a 4-year bullish market, these managers instantly across their metrics, these portfolio managers, they're gonna have to look to rotate that risk in some way, just from how that looks, and then markets reset and stabilize, and you know how that goes. But the point of this video was futures are tradable. Most markets are tradable, but they're tradable if you understand why the major agents in that market are looking to either hold on to what they possess, whether that be position or timing or price, hold on to what they possess and um, either purchase better or sell at the highest price. No, actually, that was a horrible explanation. I don't know why I just did that. Why these major agents are looking to do what they necessarily have to do, whether that's hedge funds and that is to make a large profit, whether that is banks and dealers and looking to keep their balance sheets clean, neat, while also having large amounts of selling, um, and for these portfolio managers to make sure their risk is managed and given the environment, um, their exposure is the best it can be, which is largely passive, um, and largely information based, which is why you necessarily need a catalyst sometimes, um, but that it doesn't really revolve around ICT concepts or any support and resistance concepts, etc. Kind of went off on a little bit of a rant the last few minutes, but wasn't really looking to be like too good this video. These videos are all, I think I've already said this earlier. These videos are all going to be like this, where I have very little script and I'm just kind of chatting and talking. Um, this goes like the ML route, where I start seeing people looking for like ML and LLMs. We'll discuss, but I feel like if I say LLM now, people are gonna be like trading with AI, and like they're gonna expect me to show a good wrapper for like Claude or GPT, and I'm just like I don't know if you think sending screenshots to ChatGPT is like the most OP way to trade or using one of their APIs, I think you're very confused. And if you also think like LLM and AI is the same thing, I don't know. I don't. Maybe the LLM videos aren't for you if those ever get made. But yeah, that's all. That's all. Hopeless, hopeless, hopeless. High frequency losing out. Peace.